It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, Fed pivot. Roughly a month ago, the Fed was indicating the market may be premature and expecting rate cuts. That changed following the December meeting and recent cooling in inflation measures. Currently, the PCE price index is pacing at 2.6% year over year, and the core PCE index at 3.2% year over year. Inflation is getting closer to the Fed's target, and guidance has moved towards 75 basis points of cuts to the Fed funds rate in 2024. However, the market has been even more aggressive, pricing in up to 150 basis points of cuts by year end. With market watchers expecting more from the Fed, could they potentially disappoint if inflation is not fully tamed? We will be watching. Number 2, quality investing. Since August, the Fed funds rate has been above 5.25%. The average amount of time between the last hike and the first cut is roughly 6 months. With the Fed expecting a cut in March, we are on schedule. This begs the question, what performs well after the Fed stops hiking? Following the last Fed hike, historically, quality significantly outperforms broad equities, while high beta names see underperformance. In the 1-year period, on average, after peak rates, quality outperforms by nearly 20%, and in the 3 years after peak rates, over 50%. This includes periods in which the economy did not enter a recession after a Fed rate hike cycle. Moving forward, we will be looking for quality stocks to outperform. Quality is typically defined as companies with strong balance sheets, steady cash flow, and high profitability. Number 3, getting broader. Markets have rallied with optimism around a soft landing. With this, we saw some improvement in market breadth, or the number of stocks participating in the rally. In fact, the S&P 500 saw one of the strongest month-and-a-half periods in the past 30 plus years. However, there is still a lot of catching up to do for most stocks. The Megacap 7 have led the way all year. As a result, the equal weight index has underperformed the market weight index by the largest margin since the index began at 11.7% versus 24.4%, trailing nearly 13% this year. The prior greatest trail was roughly 7%, with the equal weight index regularly beating the market weight index. Since 1989, the equal weight index has handedly beat the market weight index. The equal weight index owns each stock in the S&P 500 in equal amounts compared to the large concentration at the top of the market weight portfolio. Moving into 2024, we expect the narrow leadership to broaden out regardless of market direction. And that's been your Market Minute for the month of January. Thanks for listening.